ऑलराइट, सो मेरे साथ हैं रोहित श्रीवास्तव सर। इंडिया चार्ट्स के नाम से बहुत फेमस हैं बिकॉज ही इज द फाउंडर ऑफ इंडिया चार्ट्स एंड he was a former fund manager with Sher Khan as well, and of course he is very famous for his Elliot Waves. But आज जो हम सर से सीखने वाले हैं, that is going to be a much more interesting concept, which is trend reversal. Trend reversals, as we know, are said to be the holy grail where minimum risk रहता है and maximum rewards रहते हैं. एंड ऑफ कोर्स ऑन द फ्लिप, इफ यू आर कॉट ऑन द फ्लिप साइड कि आप नहीं आइडेंटिफाई कर पाए तो फिर आपको बहुत ज्यादा लॉस का डर भी रहता है. सो इफ यू कैन सी दैट, तो इट कैन प्रिवेंट यू फ्रॉम बिग लॉस एट द सेम टाइम इट कैन गिव यू बिग गेन्स एज वेल. वही सर से सीखने की कोशिश करेंगे एंड सर द माइक इज ऑल योर्स. आई एम हियर टू लर्न फ्रॉम यू सर.
Thank you so much. Yes, it's an interesting topic, and everybody wants to sit down and find the best ideas that they should trade in or invest in. And to do that, we need to speed up the process. There are thousands of listed stocks, and to come down from thousands to hundreds and then down to the top 5 or 10 where you need to do that additional research work is really the key to speeding up the entire process. Because in fast moving real time markets, every day we want a new idea. How do we really get to that new idea? So that's what I'm going to try and show you. What we've tried to do on our platform is provide a couple of tools that help you scan and come down to the key ideas that you really should be looking for. So I think that's the focus I want to take it to.
Right.
So is my screen on?
Yes, I can see your screen, sir.
Okay, great. So essentially what we are looking at here, the first thing I'm looking at is something known as the Dow Trend Scanner. Okay, this Dow Trend Scanner, and so scanning basically is the process of filtering out stocks, and the parameters can be varied. And we'll try and look at 2 parameters. We can come up with many others. Whenever the market turns, and this is when I want to really look at something like this. Of course, we can open a scanner any day, but when markets fall and then they're bouncing back, or when markets have been rising for a while and we feel they are starting to fall, and you really want to search for ideas where a reversal is really coming up first, then I open this Dow Trend Scanner and choose a basket that I want to run it on. So I can either choose the F&O basket, I can choose only indices if I want to actually look at where the sectoral turns are really happening. So I can choose indices or any other basket, maybe the Nifty 500 if I want a much bigger playground. Once I do that, what it shows me on the screen is based on the classic Dow theory. For those who are not aware of Dow theory, it essentially means that prices are making higher highs or higher lows, or prices are making lower highs and lower lows. And we simply coded that to show it in a chartical way. On the right hand side, as you can see, this is the Bank Nifty, which is turning from red to green, clearly showing you changes in trend based on the classic and simple Dow theory. So whenever it starts making higher highs, it turns green. Whenever it starts making lower highs, it turns red. This can be seen across time frames. So if you're looking at daily, we can choose to go to the weekly chart and see it over there, or we can go to the monthly chart. So each time frame is relevant based on what someone's individual time frame is. And like I said, when there's a market pullback, when there's an opportunity, you want to search for the stocks or sectors that are turning first. So if I actually do a scan on indices and I go to the daily, I can actually look for sectors that may be giving an immediate reversal simply by looking at down to up. So down to up here means that those indices which are actually giving a trend reversal from down to up. Now today, because the market's been up for a couple of days, no indices are really showing up in this list. But if I change this to include the F&O basket, I will end up with a list of stocks. So now within the 180 stocks, there are always going to be some stocks that are trending from down to up or up to down. So here I'm really looking at, say, Abbott on the daily charts. You can see it's turning from red to green. And this, of course, confirms at the end of the day because we've put it in live mode. You can also choose to see which stocks were showing trend reversals at yesterday's closing prices, or you can go into live mode. Now, this is an interesting feature because what I thought of it, this is how I trade. Okay, I do not really wait for confirmation signals to come in the morning. Okay, so it's not like, okay, it closed yesterday, it's given a confirmation, now let's go tomorrow morning and buy it. And the reason to not do that is, if I really step back, when I was doing back testing for automated models, I was running a long short index model at Sharekhan in the portfolio management services, and we were running this on the Nifty futures. So when I did the back testing on almost 20-30 years of data, what I really found is that sorry about that. I found that if traders execute their trades the day before versus the day after, which means if on today's closing price I'm getting a buy signal, on a particular system, and if I don't execute it before the market closes, which means at the closing price, versus I execute it next day in the morning. So I actually put that in the system that, okay, show me a back test that if I buy at the closing price, and then what is the result? And if I buy at the opening of the following day, what is the result? The difference between these results is actually almost 50%. That means if your CAGR is 30% on by buying at the close, it dropped to 15% if you bought it next day in the morning. The important lesson in this is that a lot of the gains and losses that people have are overnight gaps. Okay. So a lot is lost in overnight gaps. And if you actually cannot anticipate a trend and ride that through the gaps, you don't make the highest rates of return. You might be scalping through the day, like what day traders do. But the big returns, if you really want, you really need to hold on to a trend, making up those gaps as part of your return. The returns are much higher. And like I said, almost a 50% difference in the actual percentage ROI when you do that back test. And so I always end up executing my trades at, between 3:15 and 3:30 before the market closes based on the signals and readings that I'm seeing, which is partly why I've put all the systems here in live mode and given the option. I mean, sometimes we want to see what signals came in the previous day. There's nothing wrong with that. But I like to, really do the execution on a real-time basis. So this is the reason. But what is to be remembered is that when you do something on a live basis, the confirmation doesn't come till the closing of that particular period. So if you're actually looking at an hourly chart, you don't have a confirmation of trend till the hour comes to an end, right? So if it's 2:30 to 3:30, you actually need the closing of 3:30 to confirm that, yes, this remains green at the end of that hour. And then only you can confirm that, yes, it has changed from one color to the next color. So if it's weekly, then it would have to be Friday. Monthly would have to be the end of the month, the 30th or 31st of the month. So if I'm thinking of the daily trend, which is what I filtered here, I filtered down to up signals on the daily chart, which means stocks that are reversing from down to up based on the classic Dow theory. And I'm running it on daily, which means today's closing, if it remains positive, would give me this green bar. And of course, positive means it will close higher than the previous high made here. And that would make a Dow theory uptrend, and therefore it would remain green as long as you trend up or don't reverse down to a lower low below the previous swing low. Until that happens, it will remain green. So now I have like a dozen stocks here. Sometimes you might not even find so many. You might find even a smaller group. And once you're down to this list, it really reduces the number of stocks you're going to be looking at for ideas. Now, I usually look for ideas where there has been a pullback, because if it has run up a lot, you definitely don't want to be jumping into that gravy train at that point of time. So now that you're with the list, you can actually look at these charts. In fact, you can even switch. Like here, we're automatically seeing the Dow trend-based chart. If you really want to see the bar or candle chart, you can simply click on it and open that and look at it as well. So this is the idea. The idea is to really narrow down your list. And sometimes you might even find that what you're seeing on this list is from a particular sector. And that can actually give you an early sign that a particular sector is turning. So there are days on which I found all of them to be auto stocks. There are days I found all of them to be pharma stocks. And then that gives you a sectoral insight as well, that a particular sector might be becoming favorable from that point onward. So this is what we do. This is a first level scan. Like I said, after this, you need to actually look at the chart, figure out what is the risk reward, how far can it go, which requires pattern analysis, or even what I do, Elliot Wave analysis, to really come to those answers. But your first step is done in terms of scanning and really shortlisting what you should actually be looking at. Now you can scan on different means. This is of course Dow theory itself. Another popular scan for me is actually looking at the Rohit scanner. Now remember, let me also highlight that Dow theory and Elliot wave analysis are very, very closely linked to each other. Elliot wave theory essentially marks the trend in the pattern of 5 years. It says that if the trend of the market is up, then what that really means is that it's going to move up in 5 years. So if I simply take a blank sheet, okay, so let me just show you what I mean for those who are not familiar with some of this. I'm just going to draw it out. Okay, so if I say the larger trend is up, what we are really saying is that it's going to move 1, 2, 3, 4, and 5. Now, while Elliot essentially came up with this idea based on a study of price action, that this tends to happen on every time frame, hourly, daily, weekly, monthly, quarterly. So whether you're a long-term, short-term investor, you see the same fractal working again and again. And moment 5 completes, you get what is known as a 3-wave pullback. But Charles Dow, the father of technical analysis, as some people call him, and also behind whom we've coined the term Dow theory, in the late 1890s, he came up with this idea that what is trend? Trend was essentially a series of higher highs and higher lows. Now it's very, very simple to see the similarity between what wave analysis and Dow theory are saying. In wave analysis, we are saying this is wave 1, this is wave 2, and we say wave 3 starting and it surpasses the high of wave 1 and continues higher. In Dow theory, what we say is that when the high of 1 is crossed, then we have essentially made what is known as a higher high and higher low, because this is the bottom. This is the first higher low, which means a higher bottom. This is the first top, and moment this top is crossed at this point, what we are really saying is that the uptrend has been confirmed on a Dow theory basis. Okay, and I would say on a closing basis as well. So that would be a better confirmation that you actually close above this previous high, and that confirms that now the trend is up. Okay, so in Elliott waves we say 1, 2, 3. In Dow theory we simply say higher high, higher low. The difference being that in Dow theory we don't say that it will end in 5 waves, which was the big difference that R.N. Elliott brought out in trend behavior, that it always completes 5 waves and then it pulls back, and then only the trend will continue in another 5 waves higher. So that was the basic thesis. Now, this is the thesis which he's essentially used, and we've ended up plotting and then studying Dow theory for reversals. So the Dow theory trend reversals actually might be also an Elliott wave indication of a 1, 2, 3 wave structure development, and which is where it's sort of even a wave filtration in its own way about what is going on. The second thing that you really want to do is you want to actually see whether momentum confirms, right? You want momentum indicators to do that. And for that, we have something known as the Rohit scanner. Now, why do we call it a Rohit scanner? The reason we call it a Rohit scanner is it's based on the Rohit momentum indicator, which is a proprietary tool I developed many years ago. Not very different from what you know as rate of change or MACD, which are the classical momentum indicators, but the idea was to remove the erraticness of an ROC and to speed up what an MACD does, right? MACD is known to be a very good indicator, but also to be late in its signals, which means it is delayed. You come to know the buy-sell signal only after prices have already moved for a couple of bars. So why not get that signal maybe a few bars earlier and have a slightly more smooth indicator than in the erratic one? If anybody's plotted an ROC, you'll find it jumping all over the screen. So that's sort of what we did by smoothing, calibrating the formula, and I ended up building what we now call as the RMI. So what we are doing here is essentially looking at the buy-sell signals that generate from an RMI. Now, this, like any other momentum indicator, will have the same outcomes. It will give you buys, sells. Not every signal is a workable signal, but there are some basics that people should know while using a momentum indicator that are important here. Not just divergences, but how non-range bound indicators really work. I said non-range bound. Remember, MACD is also non-range bound. So again, take people through a slight class, because I know a lot of people are new, or some people have not been through concepts. A lot of people also don't even read books, which is one of my complaints with people. They study online. I'm not saying that online videos don't teach you anything, but all the concepts sometimes are not put together in one place. So when you study momentum indicators, there are those like RSI, Williams percentage R, stochastics. These all move from 0 to 100, which means they get capped at some point of time. And then if prices are still rising, they cannot rise anymore. So they'll just stay there, or they'll develop divergences. With non-range bound indicators like MACD or ROC, the importance is that they can go to any place. If prices keep rising very fast, the momentum indicator can keep rising. Sure, it may develop divergences at some point of time, but there's no particular limit at which it should stop, except maybe you can refer the historical range in which it was, and therefore presume that, okay, this was the previous range and therefore it will remain in this range. But those ranges do get broken. Not having a range has its own vitality and importance, because now you're not curtailed by, okay, 0 is too oversold or 100 is too overbought. Now, if you're in a bull market, we all know that bull markets can remain overbought for periods of time. So now you have nothing to tell you it's overbought. The only thing you have is you're tracking a signal. So for example, you got a buy signal here, which is essentially when any indicator crosses the 9-day exponential moving average, we call it a buy signal. And then this buy signal remains true till you get another crossover. But this crossover may or may not necessarily be the final sell signal. So when you get, in some cases it's clean, okay, that you get a sell and then the indicator simply comes all the way back down. But there are other situations in which you may get a few whipsaws and then it may come down. Okay, and the way we then filter that out is either by using a moving average or by using a trend line to help us further confirm the momentum reversal. Okay. But what's the main concept here with momentum indicators that are non-range bound is that a cycle, that is a momentum cycle, that is what I call it, is really not complete till the indicator has moved up and come back to the zero line. So this is the zero line. The zero line really reflects where momentum goes back to zero. Either if it's rate of change, it goes back to zero, or in an MACD, the difference between two moving averages goes to zero, right? They cross over. And at that crossover point, we go through the zero line. So the zero line sort of acts as the point at which we can say, okay, this cycle is complete, in the form of what I'll also call it a sine wave. So if you don't want to call it a momentum cycle, you say this is a sine wave. And you look for sine waves over and over again in price. And every sine wave is one cycle which goes up and then comes back. So till it hasn't come back, we really don't generate the next meaningful signal in any indicator. Okay, so you can have many signals, but where is the next meaningful signal? And the next meaningful signal is only after the red line, which is the indicator itself, has come down and then crosses above the 9-day exponential moving average, which is in this case the black line. So this is where the next buy signal happens. Now there's a reason why I've drawn this above the line and this below the line. It doesn't matter whether the buy signal itself got generated above or below the line. What does matter is that it got generated after completing this cycle, which means after things came back to null and zero. So this is an important concept, and to understand which are the important signals. Otherwise, every buy sell signal is a signal. And when we are actually running a scan, you'll end up with multiple buy sell signals, some of them which may not be after a cycle. And so the reason I'm showing this is that you know how to really filter out the good and bad signals, because you're down to a short list. You have just 6 stocks which are showing fresh buy signals today in the F&O basket. You want to find out of these which are the good ones. Now see, the first one, Astral, is actually a good one. Why? Because the green line has come below zero, which is this dotted blue line, and now you're getting a buy signal. Now, in every case, we don't say that this is not an algo. It's not like you execute a trade on this directly. But moment you've got signals and you got a list, you have a starting point. Right now, the next thing that you'd have to do is, and what I would do is I would apply Elliot waves and think that, okay, in wave theory, is this going to start another wave? What is my risk reward? Can I actually calculate Fibonacci levels? Can I come up with, a trade, which is something that individually people need to do. Okay, so that we don't really provide directly, otherwise it would become a recommendation. So we're trying not to make it a recommendation tool. We're trying to really make it an analytical tool where people can quickly search for ideas. And here you're down to 6 ideas. You have some of them which will be relevant, where you can do additional work and then come up with your own trade. So that's the real idea. Like now you see the second one, Bandhan Bank. It looks interesting because prices are close to the moving average. But at the same time, there's a lot of whipsawing in the momentum indicators, giving multiple buy-sell signals. So the buy-sell signals can be a concern. And at the same time, if you're very close to the moving average, you might think that, okay, this is my risk. I'm okay with it. if prices really move on, and if you can, put that mental risk in your mind that, okay, either this average or this previous swing low is the risk I'm willing to take, then you can definitely build a trade around that. So once again, I go to Canfin. Again, now this is a reading which is coming from a much higher level. And so when they come from a higher level, what we call it is a continuation, right? It's a continuation of an existing trend, which you can see in this case here. This entire trend has gone up much higher. The momentum indicator whipsaws a bit in between. And then there's a price reversal only when it breaks either the trend line or trend channel. You can actually draw a trend line from here to here. When it breaks that, that's when you actually get an actual price reversal, So, and then when is the next signal? The next signal is only after this is completely pulled back and given you the next reversal in terms of the next buy signal itself. So, sort of it helps you get patience on your side when you should really look at something. So here you're getting another buy signal. Now see, a couple of them have whipsawed in this range. So of course there's always that risk, but broadly it's at least held at this range out. So you know where the range is, you got to figure, but momentum indicators basically showing that the momentum is trying to pick up again. If it does break out of this range, it could get interesting, right? The next is Jindal.
Sure.
Here again, this is a signal much after the move has happened. And in case of Pidilite, it's early days, right? This one is also trying to bottom out, giving early signs of maybe a reversal to the upside. And so you have a couple of ideas now here where you may get interested. You'll need to study whether it makes sense in terms of trend, pattern, structure, targets, etc. And this is how we really find you. Any questions you have on this?
Right, awesome. This is amazing, sir. I do have a couple of questions. First one being, we understood about through these indicators and scanners, ki kaise we should take in position. Second, the aspect which I think a lot of people struggle with is exits. So when do we, and when I say exit, I mean both. When do you identify, okay, this I'm nearing my target, and second is stop loss as well, risk management, one aspect as well. So could you shed some light on the exit part through these as well?
Yeah, so I do really like the use of trend lines, like I showed some time back, as an exit tool, especially if I'm a positional trader. Sometimes if you feel that something has moved up a lot, okay, so say for example here I could draw this trend line of all the lows, and an actual break of this line would be an exit. Now some people may say, okay, great, that's a good exit. You bought somewhere here, you exited somewhere here. Some people feel that, okay, no, we should have fine-tuned it a little more. Now, when you think of fine-tuning, then what you're actually saying is that you start using multi-time frame analysis. So whenever we feel that we are late in a particular trade and we want to do a quick exit, we don't want to really hold on to it very, very long, then you have to step back to one lower time frame. So if I'm trading on a daily chart, I might have to actually go to an hourly chart and look for a sell signal on the hourly chart or a break of the averages on the hourly chart. So that is one way of really tightening your levels and looking for an early exit once you've decided that, yes, it's time to, move out. Another one is you could actually look for the signals themselves, because today here we are looking at new buys, but everything that is a new buy today at some point of time will become a sell, right? So there will be many which on the daily chart, maybe even giving sell signals or reversals. And that can become, one indication of the trend change. The reason I say one indication is, like, I always like to combine a couple of things. Like I've said, moving averages, trend lines. Like in this case, we are looking at this Dixon. The momentum indicators been in sell mode since 25th of August. But you haven't seen price damage. It's actually still moved slightly higher. And it's actually still sitting on the 20-day average over here. So unless you actually close below this average, which is at 4,792, you don't, sorry, that's the 40-day. The 20 days at 5,022, you don't really have a reversal in price action. So you have to make that judgment with a combination of tools. Like I said, trend lines and moving averages are useful in being able to see whether the sell signal is something to execute on. But on the other hand, if you've made significant gains, you simply want to, tighten your stops. Another way is to use Dow theory itself. It's very simple. That if you get a Dow trend reversal, which means the previous swing actually breaks. And how does that happen? Okay, so if you're looking at an uptrend, which is something like Let me just thicken this line. Okay. So this is an uptrend which is going on and going on and going on. At some point of time, when you fall below, and this is a reversal, right? You fall below the previous swing, this sort of becomes a point of exit because it's the first sign that the upward trend is reversing. In fact, on the Dow trend charts, it will turn from green to red when this kind of thing happens on a closing basis. And that's one of the signs that you have a reversal and you can actually consider that you want to book out.
Okay. Sir, next thing, one more thing I want to ask is, हमने entry देखा, exit देखा कि generally you trail your stop loss. But another thing that happens with people is कि वो position लेते ही sometimes it gets mixed up. And especially in cases of, let's say, एक sideways market गया, then momentum indicators can hit a lot of stop losses. So how to prevent those situations, if you can tell us?
So now this takes us to a higher level answer. And once we get this far, that we figured out that the best returns come from trailing because you want to ride an entire trend. But sometimes you don't get an entire trend, as you said. You get range bound or there are initial whipsaws in the trend. The way we try to handle that is by building on a position sizing model. Okay, and position sizing means that we do not buy the entire position at the start of the move. Okay, we add to it as the trend gets favorable, as the readings get favorable. So you can choose a handful of tools. Now, I've shown a couple over here. Okay, some of them are based on Dow theory. You have the RMI, then you can add moving averages, and you can list them out. And once you list it out, you have a checklist like, okay, 10%, 20%, 30%, 50%. What percentage of signals are really supporting my case to add? And accordingly, if I want to buy 1,000 shares, I will not buy all 1,000. I'll buy 100 or 200. And then after I buy that initial 200, I'm going to wait for additional confirmation from price action. Does it really go and close off the 20-day average? Does my RMI actually give me a buy signal? Or do I actually get a higher high, higher low pattern beyond this point where I'll add another 200 points? Now, the advantage of doing this is multifold. First of all, just imagine that your first trade is only 200 shares, which is when you feel that, okay, lag raha hai ki bottom ho gaya. Okay, so you take that initial risk of, okay, prices have turned positive today. Maybe it is bottom because prices are at a good retracement level or at a good moving average. But what if tomorrow they suddenly fall and break the low from which it rebounded and you thought it had bottomed out? Stopping out on a 200, which is a 20% of your expected position size, gives you a much smaller loss than you would have had if you actually bought the entire quantity. The purpose of this approach is that we are trying to overcome what no system has been able to overcome. Nobody's really been able to predict when you will go from a trending market to a non-trending market. Okay, some stocks are very trending. They simply go up, go down, and then go up again. And there are others which go up, then they pause, and then they stay in a range for a period of time before going up again. So when this range boundness happens is where what you're seeing happens is people end up hitting a couple of stop losses and then losing more in that range. And the solution really is building a position sizing model, which means till you don't get a further confirmation out of that range, you're not adding more 200 to the 200. So initially think that you bought something at 100, and then it moved up, broke out above 102. That's when I would add the second 200. Now, when I do that, imagine that what is my average price going to be? I bought at 100, then I buy at 102. My average price is going to be 101, which means that at 102, when I've made my second purchase, my cost is still below CMP or current market price. And that sort of makes it a favorable trade, unlike people who like to buy the dip. फंस गए, फिर और नीचे गया तो और ले लिया, फिर और नीचे गया और ले लिया, which means you're adding to a losing position rather than adding to a winning position. And that is why the losses keep getting exaggerated and bigger and bigger and bigger. The opposite of that is that you buy when the trend gets favorable. So if it moves in your favor, you add to it, and moves more in your favor, you add to it. So you move from 200 to 400 to 600 as a trend confirms on various parameters. All the parameters are confirming and you feel strongly about it, then you probably go in for a larger position. And by the time you do that, because the cost is going to be below your current market price, it becomes easier to exit. You can even exit. It's not at all at once. You can even exit based on individual signals. Say that one of the signals that was looking bullish gives up. but the others are still there. Maybe you can reduce your position. Instead of 600, you go back to 400. So that's another way to manage in trading ranges. You're not going all in, and you're committing on a limited way. And if something fails, you can get out. Or if it goes below your cost or hits your cost level, also you get out. Your loss is much smaller than if you're actually waiting for the stop loss to hit on an entire position, and you hit 3-4 stop losses and you've made a significant loss.
Right. Perfect, sir. So another aspect is whatever we discussed are mostly technical indicators, and as I understand, you primarily analyze only technical charts. But do you look at any of the fundamental factors in this analysis, or is that like even if it's liquidity purpose, and market cap or something like that, or you stay completely away from that?
So we go into those aspects depending on what particular product you are trading. Say, for example, if I'm trading options, one thing that I do want is that options remain liquid, which means that when I want to sell, there should be a buyer. And the only way to ensure that is that the open interest in that particular contract is large enough, right? So if you're looking for liquid options, you look for contracts that actually have an existing open interest. So there will be buyers and sellers interested in getting in and getting out at different price levels. So that is like a basic thing that you actually search for. Similarly, even in futures market, you want to be in liquid contracts and not in illiquid contracts. But if you're not a trader and you're a long-term investor, then I do have something known as the value wave model. Can't go very deep into it in this session, but essentially it involves looking at Elliot Wave analysis and looking at where you are in terms of the business cycle. Is it a value stock? Is it a growth stock? Where is it in that? On a slightly longer term. So you're looking at the wave structure on maybe a weekly or a monthly chart, and then trying to determine whether the stock is in a value phase, growth phase, or fifth phase where it's actually a defensive sector growing at a slower rate but still growing. And by being able to put that together gives you greater confidence in terms of what to expect next. Because if you're in a value phase, the third wave will start in that particular stock. You'll end up in a growth phase. So we do look at the combination of fundamentals and technicals. We don't have it right now on this product, but approximately, I think, give it 2 to 3 weeks, all the fundamental screeners would also become available on this platform.
Okay, awesome. Finally, sir, you also briefly touched upon it. The complaint that you have with people who are trying to learn markets is they don't read enough books. So, could you tell us a little bit about, or maybe your favorite books that are out there, and also a few books that the initial phase में लोगों को कौन सी books पढ़नी चाहिए? If you could give us some recommendations around that.
So if people are looking at studying charts, getting the hang of it, there are non-known classics that anyone can go through, and they are more than sufficient if you've gone through these. One of them is Technical Analysis of Stock Trends by John Magee. This is one of the Bibles of technicals in terms of price patterns, volume, behavior. It's written somewhere in the 60s. The next one I would say is from Martin Prinks. I could also recommend John Murphy, but if you like simple reading in terms of words and language, I think Martin Prinks actually does a very good job of doing that. But also Martin Prinks also may be called the father of momentum, momentum investing, because he's actually written a book. It's a 2-set book on how to use momentum indicators, and sort of covered all the momentum indicators there, many which even I may not use, because finally you're only going to use 1 or 2 of them. But so many exist because different people have different ways of looking at the market. There are some core principles with which you look at any momentum indicator. And then, of course, there's knowledge about each one separately. So his 2-book set, which was originally 1 book when I first read it in the 1990s, now it's a long 2-book set, is a Bible for basically understanding the use of momentum indicators. So I think that is a must for anyone who's using any momentum indicator, to understand them, how they work, how they should be applied. And then once you've done all of this, which is, classical technicals, indicators, and, price patterns, volume, and you get interested in, well, what about Elliott Wave theory? Because it's the only forecasting tool which tries to help you estimate how prices will move, where they'll move using Fibonacci ratios and so on. Then you end up reading Elliott Wave Principle by Frost and Prechter. That is the classic book for learning Elliott Wave analysis. And it's also one of the thinnest books that you find in technicals. Most of the other technical books are nice thick books. But Elliott Wave Principle is just a nice thin book where half of the book is most of the subject, and the second half simply takes you through examples and his journey of early counting. So I think this is sort of sufficient for learning the science part of the story. But even after you have learned everything in the science of markets, you are still going to fail, because eventually it's not just the science but also the mind that most traders need to overcome. And when it comes to overcoming the mind, you'll need to study something known as behavioral finance. Within that, there are a couple of classic books which not directly subjects of, not textbooks of behavioral finance, but actually good ones to learn from. And the most popular one is Reminiscences of a Stock Operator, Jesse Livermore's story. And through his story, actually brings out nuggets of behavior and patterns that he observed through his own learnings. He made those mistakes. He made millions, lost millions, made back again. And through those makings, whatever he learned has been noted down and jotted in that book. So it's a really interesting read for people to learn something about the whole subject. And another one like that, which actually tries to talk about different market participants and explain their role in the markets, is something known as The Money Game by Adam Smith. Okay, so there I've given you an entire list of books. If people have not noted it down, they can simply go to the Educate Yourself section of the indiacharts.com website, and I've listed my entire resource list over there. Many more podcasts and channels, but I think these books, which I've just highlighted, should be sufficient to take your journey from 0 to triple X at least.
Right. Awesome. This was an amazing session, sir, but I'm sure we have so much more to learn from you, including, I think, next topic to मुझे पता ही है, which you said, even your आपका जो value and growth वाला model है, where you look at fundamentals and then उस पे करते हैं, तो we have that yet to learn. I already know, and I'm sure there's so much more. So for now, this was our time, but please do allow us to host you again and learn more from you, sir.
Surely. Thank you so much.